Real estate has been the talk of the town as overseas hedge funds point to an Australian property bubble and the Labor opposition floats major tax changes to negative gearing. Few companies are more exposed to the fortunes of Australian property than real estate agents. One of the major players, McGrath, listed on the ASX in December and has seen more than a third of its share price wiped off in 3 months. Michael Yander has this report.
Judging from the flashy cars, real estate agencies look like a licence to print money. When the market's booming, they probably are. But when the market turns, it becomes a very tough game.
Just because you sold 100 last month doesn't mean that you're going to sell 100 this month. It's all relative and it's all going to be controlled by market forces outside of the business.
That's a lesson that investors in McGrath Real Estate are quickly learning. After listing at $2.10, the stock's lost more than a third of its value in just 3 months. That doesn't surprise fund manager Roger Montgomery, who passed on the opportunity to buy in.
When we're investing in a float, we're looking for two things. We're looking for quality and we're looking for value. And for us, neither of those things, to the standard that we expect, were present in the float of McGrath.
He doesn't think real estate agencies are a bad business, with relatively low overheads and the potential for high profit margins. But the float's timing raised eyebrows. A looming apartment glut combined with a 50% price surge in McGrath's key Sydney market makes for a volatile mix.
Wherever there's been an oversupply, the prices have subsequently fallen. And agents are in the firing line when property prices go down. And we think we're in line for a correction in property prices.
And that's led him to a valuation which suggests the pain is far from over for McGrath shareholders.
It was around $1 rather than $2. And that was partly because of our assessment of the future, not just the company's performance to date.
Chris Savage from brokerage Bell Potter, which helped manage McGrath's float, is much more upbeat, valuing the company at $2.25.
Well, the share price is about 30 to 40% below my valuation and about 30 to 40% below where the IPO price was. So in very rough terms, you could argue that the market's anticipating a 30 to 40% drop in the property market. Personally, I'm anticipating relatively flat volumes and pricing going forward for the short to medium term, and that's factored into obviously my forecast and valuation.
Back out in the burbs, Edwin Almeida says forecasts of a property bust are already becoming reality in his patch around Parramatta in Western Sydney.
We've identified some areas where properties have actually gone backwards already by anywhere between 8 to 15%. Asking prices are dramatically being pulled back, in some parts of Sydney by up to 20%.
$90,500.
Not only does that mean reduced commissions, it also means a much longer wait to get that cash as properties sit on the market for months instead of weeks.
We're moving from 21 days, where you could almost be guaranteed an income from the sale of the property within 3 months. Within 10 weeks, you'd have money in the bank. Now we're going into possibly even a 5-6 month period before we actually get paid.
But John McGrath and his co-owners won't be too worried. On Roger Montgomery's estimates, they've already realised most of the business's value in cash, while still retaining almost half of the listed company. Out of nearly $130 million raised in the float, about half was used to partially buy out McGrath's existing owners. Another $32 million went to the Smollen group of McGrath franchisees, $16 million paid off existing debts and $10 million covered float costs, leaving only $8 million as working capital.
So you haven't got much firepower to actually go and buy more practices if you really do want to expand.
None of this should surprise shareholders. It was all clearly laid out in black and white in the prospectus. After building his business from a single Sydney agency to over 80 across 3 states and the ACT, who can blame McGrath for cashing in? But it is another cautionary tale of buying into floats when private owners are selling.
When a highly knowledgeable, skilled and successful real estate agent is selling down their own exposure to their business, that for us is a red flag.